There's a difference between an equity purchase of a business and asset purchases. So an equity purchase means that you buy the entire business, because assets less liabilities equals equity. Equity is the true value of the business. So you may pay multiple of the equity value of the business. So 3 times equity of $1 million, you pay $3 million for the business as an example. So that's an equity purchase. That's the whole thing. Now you can also have specific assets that are purchased. So maybe the buyer wants a certain product line or certain store locations. So that's asset purchase, which is not the whole business. Now there's a sensitive topic that comes out, particularly in private businesses, when a potential buyer is looking at buying a business from a seller. And we refer to these as normalizing the accounting records. So what you can imagine is that the buyer is going to get the financial statements and then say, well, in this hypothetical, in this forecast, I think we should have these adjustments, because these adjustments put the financial statements consistently with other accounting standards. And we'll use 3 examples here. So the first is very common: company cars. So there are several people in the business who have company cars. So the company's paying car payments, repair expenses, and insurance, maybe some other miscellaneous things for company cars. And the question is, are these cars really needed in the business to generate revenue? The purpose of an expense you incur it to generate revenue. Is this really necessary? If the answer is no in the eyes of the buyer may say, well, when I create my bid here, I'm going to adjust the financials as if those expenses don't exist. And if I buy the business, I'm not going to pay those expenses. So that would be one, car payment. Second, related party transactions, which means you're doing business with somebody who is not an independent third party. The buyer and the seller have an interest. So let's say that the CEO of the company has a son, and the son is leasing a factory building to the business. So son of CEO leases a factory building. Well, it's probably the case that that lease agreement is not consistent with what a lease agreement for a similar factory would be in the real market. It may be higher, it may be lower, but it's not consistent with reality. So what a potential buyer may say is, if I buy this business, this lease needs to be either eliminated or renegotiated so the lease rate I'm paying is consistent with what other comparable buildings would charge me. So when I make my bid, I'm going to adjust my bid for that lease so it's renegotiated in my assumptions. And thirdly, operating income, non-operating income. Operating income is from day to day running your business. You want to make sure that non-operating income, like a gain on sale, is not included in operating income.